Outlook 2017. Today we're focused on asset allocation, and I'm joined by James Bateman, Chief Investment Officer for Multi-Asset. James, the victory for Donald Trump in the US election was taken very differently by the equity market and the bond market. What's going on there, and how do you think that sets us up for 2017?
Sure. So what we've really seen is maybe the start of the much anticipated great rebalance between equities and bonds. What you've seen is this lengthy period of bond returns being well above normal, well above long-term expectations, driven by incredible central bank easing and low interest rates. The expectation that someone like Trump may instigate fiscal stimulus, create economic growth, and therefore cause interest rates to rise has had a dramatic impact just within a few days in terms of the bond sell-off and the equities rallying. That probably is our central case for next year and beyond, that actually for a year or more, fiscal stimulus, provided it comes, provided the US houses don't veto it, will lead to further economic growth, some inflation, rising interest rates, and therefore equities should outperform and bonds should underperform, all other things being equal.
Right, okay, so if we do get the growth and we do get the inflation that goes with it, presumably we're also likely to see more rate rises, maybe rising further and more quickly than we would otherwise have done.
Yeah, and I think, when you actually look at market expectations, they're already pricing in rate rises. The number hasn't necessarily moved that much, but I think the certainty around those moves has increased. So the likelihood of a Fed rise either late this year or early next year is certainly priced very highly. We'd caution on being too optimistic on repeated rate rises. We think that when you actually look at the world and you look at what we've been missing since the financial crisis is economic growth, and we know rate rises choke off economic growth because they're also trying to choke off inflation, and therefore rate rises may be slower than expected because the price of high economic growth and above normal economic growth might be a bit more inflation, but that might be a good decision.
Now, James, I mean, your funds invest all around the world, so presumably the impact of these changes will be different in different parts of the world. Is it good for developed markets, bad for emerging markets, or how do you see that balance?
It certainly could be. Emerging markets, as you'll know, sold off pretty much immediately on the Trump victory news. A lot of that was Mexico and concerns around there, but actually more generally there's concern around protectionism and China and what Trump might do there. So on the one hand, it could be very good for the US. Fiscal stimulus will push up the market. Fiscal stimulus may well spread around the developed world. The average person is tired of austerity, tired of purely using monetary policy as a lever, and actually any economist would tell you monetary policy hasn't actually done much good over the last few years. So some fiscal stimulus might bring much needed growth across the developed world. We've seen signs of it in the UK, or hints of it already in the UK. If we see that, we'll see developed markets outperform. Emerging markets, though, are difficult because actually it's a very heterogeneous group of countries, and whilst as an overall asset class there might be some losers with potential dollar strength and other factors, there are certain countries that might do very well in that environment.
James, thank you very much.
Thank you.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书或投资人须知。